How does the mortgage stress test affect the housing market? Why was the mortgage stress test created? In late 2017, the federal government introduced a mortgage stress test to apply exclusively to uninsured mortgages. The new stress test of June 1, 2021 applies to both insured and uninsured mortgages. How does the bank determine your qualifying rate? It's not the rate lender offer you, for example, 1.78%. It's your mortgage rate offered by your lender plus 2%, or benchmark rate, posted 5 years mortgage rate. Before this old stress test, the benchmark rate was 4.79%, and from June 1, 2021, the new benchmark rate is 5.25%, which has increased to 0.46%. Bank will use whichever is higher to determine your mortgage eligibility to ensure you'll be able to make your payment if rates go up. To put this into real terms, if you wanted to borrow $400,000 and your lender is offering you a rate of 1.78%, you would have to prove you can afford a mortgage payment at 5.25% annual interest rate of about $2,385 per month. Even though your actual monthly mortgage payment at 1.78% would be considerably lower of about $1,650. Because interest rates have been at historic lows and will ultimately go up, the government wants to ensure you will be able to afford your mortgage payments when rates eventually do rise. Otherwise, if you can't afford higher payments in the future, you might be forced to default on your mortgage and lose your home. Now let's go back to the question everyone is worried about. How does the mortgage stress test affect the housing market? Residential transactions reported through MLS system remained high during the month of May 2021. The housing supply shortage in Southern Ontario has been well documented and has acknowledged that supply is an issue. Average selling price in the GTA area has increased 28%. People and business are more likely to locate in regions that have an unparalleled supply of affordable home ownership and rental options.